Welcome back to the Chattable podcast, where we learn real English in real life and have fun and be proud.
Absolutely.
And today we have a very clear mission for this episode. We are looking at the specific language of inflation.
Yeah, how we talk about costs going up.
Exactly. We are going to unpack three highly visual business English phrases that describe financial realities, pricing, and market momentum.
Because the language of business is fundamentally metaphoric, right?
Like,
we are moving past the dry spreadsheets to see how professionals actually talk about these things.
right, and those three phrases are sticker shock, feeling the pinch, and runaway.
It is a great progression.
Let's just jump straight into the first one, which is sticker shock. I feel like if you have gone shopping recently, anywhere, you know this feeling.
Oh, definitely. It is that immediate psychological impact of a price change. It describes that brief moment of cognitive dissonance at the register.
Or the digital checkout cart.
Exactly.
Right.
When you realize the price of an item has completely detached from your internal expectation.
That concept of an internal expectation is the core of this phrase. Look at the main sentence from our sources for this. It says, consumers are experiencing sticker shock for premium tennis court time due to rising inflation over the past few years.
Right, because renting a tennis court is a recurring service. The consumer already has a number in their head based on years of habit.
Behavioral economists call that a reference price.
Oh, they do. When you rent a premium court every summer, you anchor your expectation to last year's rate. But inflation is this macroeconomic reality that degrades purchasing power over time.
Yeah, you might understand that inflation is running at like 4%, but...
But human brains do not naturally apply compound interest to their weekend hobbies.
No, they don't. You show up at the club expecting to pay $50 an hour, and the manager asks for $80. That delta between the expectation and the new reality is where the shock happens.
It is an involuntary reaction, a broken psychological contract.
But the facility manager is dealing with the realities of commercial real estate. Premium courts need maintenance, climate control, lighting, and property taxes are going up.
Their operating costs have surged. They literally have no choice but to adjust pricing.
But they haven't communicated those incremental increases to you week by week.
So the price hike appears sudden and almost punitive to the player.
What I find fascinating is the origin story of this phrase. Sticker shock didn't just appear out of nowhere.
No, it has a very specific historical anchor.
It was forged in the American automobile industry in the late 1970s and early 80s.
Right. To understand it, you have to look at the Automobile Information Disclosure Act of 1958.
A Monroney sticker.
Exactly, named after the senator who sponsored the bill. It mandated that all new cars display a piece of paper on the window detailing the manufacturer's suggested retail price.
The MSRP, the cost of options, fuel economy, all of that.
Prior to that, buying a car was an exercise in extreme asymmetric information. The dealer knew the cost, the buyer was in the dark.
It led to crazy price gouging. So the sticker was pure consumer protection.
But that transparency was ironically weaponized against the consumer 20 years later.
Because of the global economy in the 70s.
Yeah, the Arab oil embargo led to severe supply shocks. Central banks were grappling with stagflation.
Which is that toxic combination of stagnant growth and double-digit inflation.
Car manufacturers were suddenly paying exponentially more for steel, rubber, labor, energy. To avoid bankruptcy, they passed those costs to the consumer.
And because of that 1958 law,
they had to print those massive price hikes in bold black ink and glue them to the window.
Till a consumer who bought a car in 1974 for $4,000
comes back in 1979 with that $4,000 reference price in their head.
They walk up to the car, look at the sticker, and see $7,000.
The velocity of that increase triggered a physical blow. Journalists started observing buyers literally recoiling on the lot.
And they coined the term sticker shock. It perfectly encapsulates how a massive global event distills down to one person staring at a piece of paper.
And having a visceral reaction.
It's permanently embedded in business English now. We use it for real estate, healthcare, and sporting goods.
The transition to consumer goods is seamless because the psychology is the same. Look at the conversational example with Carlos and Novak.
Carlos asks if he saw the price of the new carbon fiber rackets.
And Novak says, yeah, total sticker shock. I might just keep playing with my old gear for another season.
That is the ultimate consequence. Demand destruction.
He doesn't just experience the shock, he alters his behavior. He abandons the purchase.
Which is the nightmare scenario for corporate pricing strategy teams.
They spend millions trying to avoid that. Pricing a premium product is a delicate balancing act involving price elasticity of demand.
which measures how sensitive a consumer's desire for a product is to its price.
A tennis racket is a discretionary purchase. It is not groceries. If the price breaches a psychological threshold, the elasticity snaps.
And consumers opt out. But the manufacturer risks that shock for a reason. Carbon fiber manufacturing is vulnerable to supply chain disruptions.
The raw materials are petroleum derivatives. It takes massive energy to bake the fibers.
Plus, sporting goods compete with aerospace and automotive industries for that high-grade composite.
When Boeing or electric vehicle makers increase orders, the supply for secondary industries plummets.
So the racket maker is caught in a bind. Material costs spiked. They spent heavily on research and development. To maintain profit margins, they raised the retail price.
And hit Novak with total sticker shock.
And Novak's decision to stick with old gear highlights the vulnerability of durable goods.
A high-quality racket doesn't degrade immediately. You can delay the purchase.
If a company miscalculates the sticker shock threshold, they don't just lose one transaction.
They potentially lose that customer's revenue for an entire product cycle.
The phrase is such a brilliant shorthand. When Novak says sticker shock, he communicates this entire complex web of economic friction without a chart.
He is signaling that the perceived value of the upgrade is outweighed by the pain of the price point.
It is grammatically flexible, too. You can say experiencing sticker shock or use it as an adjective. Analysts talk about sticker shock risks.
It's an acute event. You see the price, you feel the shock, you can walk away.
But the broader economy rarely lets you just walk away. The pressure of rising costs isn't always a sudden jolt you can opt out of.
Sometimes it is a chronic condition you have to survive.
Which perfectly transitions us into the second phrase for this episode, feeling the pinch, or simply, the pinch.
While sticker shock is sudden, the pinch is prolonged. It describes the lingering reality of margin compression.
It's a very physical metaphor, squeezing something tightly between your finger and thumb.
In corporate finance, you are squeezed between two unyielding forces.
Rising operational costs pushing up from the bottom.
And a rigid price ceiling pushing down from the top.
If a company cannot raise prices because they're terrified of triggering sticker shock, they have to absorb the expenses.
The space between their revenue and costs narrows. They are financially pinched.
Our sources give a great industry example here. Recently, all the racket and string makers have been pinched with the tariffs and rising costs.
Tariffs are a reliable catalyst for margin compression in global manufacturing.
It is basically a tax imposed by a government on imported goods. Modern tennis strings are highly engineered synthetic polymers.
Copolyesters, Kevlar blends, the facilities for these are frequently overseas.
Heavily reliant on multinational supply chains.
When a government implements a tariff regime, the cost of importing raw materials instantly increases.
The manufacturer faces a 20 or 30% surcharge at the port, an external shock to their cost of goods sold.
The instinct is to pass it to the retailer, then the consumer.
But the sporting goods market is intensely competitive.
If brand A raises prices by 30% to cover the tariff, and brand B eats the cost to gain market share,
Brand A loses shelf space.
Therefore, manufacturers try to hold retail prices steady. The top line, their revenue per unit, stays flat.
The bottom line, their cost per unit surges upward.
That shrinking territory in the middle is their profit margin. When executives say they are being pinched, they mean systemic erosion of profitability.
It is agonizing. They have to find efficiencies to survive. Reduce marketing, halt hiring, switch to cheaper packaging.
The pinch forces companies to cannibalize their future growth to maintain current survival.
And this vulnerability isn't just for big corporations. It perfectly describes individuals in a gig economy or freelance structure.
The conversational example with Coco and Iga grounds this.
Coco mentions how much it costs to travel internationally for tournaments now.
And Iga replies, I know, independent players without big sponsorships are really feeling the pinch this year.
This opens a fascinating window into professional tennis microeconomics. People think it is a sport of unimaginable wealth.
Private jets, luxury watches. But that is the top 1%.
The vast majority operate as independent contractors running a highly volatile logistics business.
A player ranked outside the top 100 is entirely responsible for their own overhead.
Commercial flights across Europe, Asia, the Americas, hotels, nutrition, stringing fees, coaches.
Over the past few years, the macroeconomic environment has been hostile to this model.
Aviation fuel prices spiked. Hospitality room rates drastically increased. Their operational baselines skyrocketed.
Crucially, the prize money at lower-tier tournaments has largely remained stagnant.
This is the exact definition of the pinch.
Their income is fixed by the prize structure, while logistical costs are exposed to global inflation.
IGA saying they are really feeling the pinch is an understatement of a structural crisis.
When an independent player is pinched, they make brutal compromises that impact competitive viability.
They travel without a coach, skip a crucial tournament because the flight breaks the budget.
They sleep in budget motels far from the venue, adding transit time and physical fatigue.
Every compromise forced by the financial pinch erodes their performance on the court,
Making it harder to win matches and secure the prize money they need to escape the squeeze.
It is a vicious, self-perpetuating cycle.
The contrast between the two phrases is a masterclass in business communication.
Sticker shock is a defensive reflex. Novak protecting his capital.
Feeling the pinch is a condition of ongoing endurance. The string maker surviving a trade war, the athlete fighting a shrinking margin of error.
Both phrases deal with the friction of rising costs on a human scale. Localized pain.
But the global economy is not always manageable. Sometimes metrics detach entirely from historical baselines.
Standard mechanisms of control fail. This brings us to the final phrase of the episode.
Runaway.
Runaway scales up the conversation from personal budgets to systemic, overwhelming momentum.
We are invoking the terrifying imagery of a massive vehicle that has lost its brakes.
A runaway train or a runaway horse. It implies mass multiplied by velocity.
In physics, momentum is hard to arrest past a certain threshold. In economics, runaway describes a trend or inflationary cycle that is broken free from underlying fundamentals.
It accelerates based purely on its own internal momentum. Normally, economies have friction points designed to slow things down.
Central banks raise interest rates to cool an overheating economy.
Companies adjust supply. Those are the brakes. When analysts say runaway, they're explicitly stating the brakes have failed.
The source material provides a great sentence for this. Runaway rises in sports apparel stocks helped push the equity prices to new highs.
We are moving from the cost of goods to the valuation of companies in public markets.
An equity price is theoretically supposed to represent the present value of future cash flows.
If a company sells more shoes, increases profit margin, its stock goes up.
But runaway rises suggest something far more volatile than logical growth.
A runaway asset class is usually fueled by irrational exuberance.
A term coined by Alan Greenspan. In sports apparel, companies like Nike or Lululemon see consumer trends intersect with speculative investing.
The athleisure boom changed global fashion. But the market collectively decided the sector was immune to economic downturns.
Retail investors, algorithms, momentum traders all piled in simultaneously.
They weren't analyzing price-to-earnings ratios. They bought the stock because the price was going up.
That self-fulfilling prophecy is the engine of a runaway market.
The rising price attracts more buyers, driving it higher, decoupling valuation from actual sales. The sentence notes, these runaway rises helped push equity prices to new highs.
Meaning the momentum of this specific sector was so massive it dragged broader market indices up with it.
The financial equivalent of a gravitational pull. The sheer size and speed overpowered bearish sentiment.
A critical point about the word runaway is that it rarely exists in isolation.
A runaway train alters the environment, creates wind shear, destabilizes infrastructure.
A runaway economic trend forces everyone else in the market to react to it.
Even if a portfolio manager thinks the stocks are overvalued and tries to short them.
Betting against a runaway trend is notoriously dangerous.
The market can remain irrational longer than you can remain solvent. You can be mathematically correct, but the momentum will bankrupt you before the correction.
And momentum applies to cultural phenomena driving massive capital allocation too.
We see this in the final conversational example. Venus and Serena discussing the transformation of their sport.
Venus points out the broadcasting rights for the Grand Slams are worth billions today.
Serena identifies the root cause. The runaway popularity of the sport globally has completely transformed the business.
This is the high-stakes world of modern sports media rights, an industry that experienced dramatic runaway growth.
To understand the billion-dollar valuations, look at the fragmentation of global media.
20 years ago, linear television dominated. Sitcoms drew synchronous audiences. Advertisers paid a premium.
But streaming services destroyed that model. Audiences fractured, watching on demand without commercials.
Traditional networks hemorrhaged viewers and ad revenue.
The only asset class immune to this fragmentation was live sports.
A Grand Slam final demands synchronous, real-time viewing. You cannot DVR it without getting spoiled.
Advertisers realize it is the only way to capture a massive captive audience simultaneously.
This triggered a runaway bidding war. Traditional broadcasters had to compete with massive tech conglomerates.
Amazon, Apple, they realized live sports are the ultimate customer acquisition tool.
When Apple enters a bidding war, traditional valuation metrics are irrelevant.
They aren't looking to turn a direct profit on ad revenue. They use the sport's runaway popularity to drive subscriptions to primary services.
The popularity of tennis itself became runaway. Globalization, iconic rivalries, digital highlights.
It created fan bases in emerging markets. It transcended country club roots to become a global cultural product.
So you have a runaway cultural phenomenon colliding with a runaway structural panic in media.
The synthesis of those two runaway trends produces the billion-dollar valuations Venus mentioned.
The sport is an anchor asset in a trillion-dollar media war.
Serena's use of the word perfectly captures that paradigm shift. The sport went runaway, permanently transforming the underlying business model.
If we step back and look at the progression of these three phrases, there is a clear escalating architecture.
We move from the micro to the macro.
Starting with the smallest unit of economic friction.
One individual looking at one price tag. Sticker shock.
The legacy of stagflation distilling down to Novak refusing to buy a racket.
From that localized moment, we expanded to structural reality. The pinch.
The painful margin compression when top-line rigidity meets bottom-line inflation.
The string maker navigating tariffs. The independent player fighting travel logistics.
The pinch is the chronic condition of modern business. The silent squeeze demanding efficiency.
And finally, we abandoned localized friction for systemic failure. Runaway.
Uncontrollable momentum detached from fundamentals.
Irrational exuberance driving equities, and fragmented media turning runaway popularity into broadcast monopolies.
This language proves economics is a behavioral science. Professionals aren't just reporting numbers, they are communicating psychological and operational reality.
Turning abstract data into visceral human experience. Mastering this vocabulary helps you sound natural and engaging.
It bridges the gap between quantitative analysis and qualitative communication.
If you see margin compression and say, we are feeling the pinch on our supply chain, it instantly contextualizes the data.
It shifts the conversation from defensive posturing to collective problem solving.
It turns a boring financial report into a vivid story. Before we wrap up this episode, I have a final thought for you to mull over.
Oh, this is a good one.
We have spent this time analyzing how physical sensations, a sudden shock, a tight pinch, a speeding train, describe invisible economic forces.
The metaphorical mapping of the physical world onto finance is relentless.
It really is. The next time you listen to the financial news, pay attention to the metaphors. What other physical actions do we use to describe the movement of money?
You hear analysts say a company is hemorrhaging cash as if it is bleeding out.
Or liquidity is drying up, like capital is a water source in a drought.
Dead cat bounces, market contagion.
The vocabulary of business is deeply physically human. Pay attention to those metaphors because they reveal exactly how the market is feeling. Thank you for joining us for this episode, and we will catch you next time.